Okay, so this is going to be the second presentation in a row, which is a very early stage, but it builds on a lot of themes that were mentioned yesterday about, to quote Rajan right at the end, about inculcating a culture of a more equity-like financing in many low and middle-income countries. So it starts with the development motivation. We have very low labor force participation for women in Pakistan, amongst the lowest in the world. We have barriers to outside work. Even for women who do work, it's often home-based. And we have very big mobility and safety constraints. Essentially, this means that many women are restricted from access to high return opportunities. In this project, we're going to be financing a high quality, high potential return asset, but quite costly, and it's a transportation asset for women. So finance motivation. We have some evidence now that microfinance can be too micro in some settings. So in a similar setting in Pakistan, we worked with a bank which removed the previous limit on borrowing, and we had 4 times the amount of borrowing, and we found high returns to asset financing, and others have also found some high returns to asset financing. We also have some evidence that microfinance can be too rigid in some settings, especially for higher risk, lumpy investments. Now, the classic microcredit contract has many theoretically appealing features which mitigate adverse selection and moral hazard in informationally opaque lending markets. In particular, rigidity may be optimal under costly state verification and limited commitment, but we have a lot of evidence, even from an older literature and development, that risk-bearing capital can benefit small fund owners, and we've heard a lot about that in the last day or so. Digitalization, as we've heard, dramatically reduces monitoring costs and expands the contracting space. So again, we've heard a lot in the last couple of days about how do we use these rails and build more and increase the number of products that people have available to them. And so this agenda is in that spirit. Chris had this slide from the startups paper where firm owners wanted equity, but they didn't want to give up control. And it's kind of like a tongue-in-cheek comment that he made. And my interpretation of that with our work is that people want possibly risk-bearing capital, and we should explore contracts where they don't dilute ownership and don't dilute control. And so, like as Apoorv said, it's kind of like debt-based contracts that have some sort of state contingency within them. So we're going to offer 2 types of contract to finance this transportation asset for women. One is a standard kind of debt contract, and one is a variant with performance contingent repayments. So the target sample for our experiment is 1,000 women in Punjab. Families will be engaged with as part of this process. We had a pilot with around 100 women. We found high demand for this transportation asset and usage by other household members. So we're not going to restrict it just to be used by the women. We found higher returns to capital indicatively from this pilot, low demand for selling their services on platform, Uber specifically, and sensitivity to having a large fixed repayment for this asset, which is unsurprising given that this is expensive asset. It's $500,000 rupees, just under $2,000 US, which is 12 times monthly household income and 6 times the average loan size. So we're working with 2 of the largest rural lenders in the country. We were working with Uber and Careem, who decided to shut down and leave all their operations in Pakistan. I can assure you that this is just a correlation with my working with them. It's nothing to do with the project itself. Don't infer that as a negative signal. We are now working with the largest ride-hailing company just to give women access to this ride-hailing network in case they do want to sell rides on that platform. We're also working with some high-quality manufacturers of the assets, and the traffic police and the Safe Cities Authority, who basically have CCTV cameras across the city. So it's very important for us that we provide a safe asset for women, where there's a button that they need to press if they don't feel safe, and it can go straight to the police. Okay, so I'm going to talk about 2 elements of like financial structuring for this project, like back end and then front end in terms of the contracts that are being offered for the women. On the back end, the lenders that we were speaking to recognize the value of this investment, both for the women and for themselves, but they were reluctant to enter into it because it's quite a risky population for them. And so we address this with a first loss guarantee-like structure where there's some element of paying them just to meet project targets, like delivering loans, finishing the implementation, but also a first loss guarantee and a convertible first loss guarantee structure where they can draw down on the pot based on some losses, but then at the end, it would also be paid to them based on some deliverables. Now, to do this, we drew inspiration from a few other finance and development teams, Michael's team, Adam Osman, who worked with Dean Collin and others. And so, this is similar to some of the first loss guarantee structures that have been implemented by other teams recently. on the front end, like the financing that the women would actually experience, well, we have a standard kind of debt contract, which is 30 months, 15% deposit, 20% APR. And then we have a flexible contract. It's flexible. They still have to pay the same nominal amount as the standard debt contract, but on a month-to-month basis, the repayments will move with some proxy for performance, which we're going to use GPS trackers for to measure how much they're moving. And so the duration of the contract will actually adjust, and that's where the flexibility comes through. And the contract can be as long as 4 years, right? So pushing a little bit in the direction of longer term financing. And so this is the monthly payment for the flexible contract. We have some component, which is a fixed repayment component, which is the same as the debt contract, 50% of the debt contract's fixed payments component. And so we've implemented something similar in different contracts, and it worked well. Then we have this flexible component, which is 10 rupees multiplied by the distance driven, subject to a cap and floor. The distance that we're going to be using is based on what we infer from the GPS trackers from the vehicles. And so if they travel less than 200 kilometers in a particular month, they're still charged the minimum amount. So the minimum payment is 10,000 per month. If they travel more than 3,200 kilometers in a month, they never pay more than 40,000. So we're trying to mitigate moral hazard in that respect. And then we have values in between. And so this was calibrated based on the pilot data so that the kind of median entrepreneur, she would have expected payments under the flexible contract, which was similar to the fixed duration contract, just to make it a bit more of a fair forced rate. So it was actually a bit less favorable than the debt contract. It works against us, but I think that's fine. Now, if I turned up to the women and explained the contract with this min-max formula with a cap and floor, I mean, they would probably kick me out of the room, if not worse, right? I'm sure the microfinance institution as well will do that. And so we tried to design this app where we explain how this contract works. Essentially, you have a cursor, your vehicle moves a little bit, and it shows you how much your payments are moving as your performance moves. I have a QR code at the end. If anybody wants to look at our app and give us feedback, please feel free to do that. Okay, so the experimental design is that we're aiming for 1,000 women, control and 2 treatments. The treatments bundle financing with some sort of driver training just to make sure that they are aware of the rules of the road. And we're working with the police force on that. We have data, we're collecting data from GPS trackers, lender repayments, and also some surveys. The main outcomes, kind of very intuitive sequence of outcomes, take up of the different contracts, repayments under the different contracts, and then income and household consumption from the women and as well from the household. We have women's empowerment variables and also some dimensions of heterogeneity, both thinking about preferences, but also subjective beliefs about treatment effects, and importantly, whether there's a presence of a male business in the household, which has been found to be important in other contexts. Thank you very much.
I mean, I'm not like Emmanuel. I haven't scanned the QR code yet, but from the screenshot you showed, it sort of only implied that the payments are increasing the more you drive. Like, so then I don't know. Like, if I don't understand that it's just extending the loan period, would I think it's optimal to drive as little as possible?
That's a fair point. So you're saying because the app's only showing you the implication on a given month of. That's a good point. That's a good point. Whether we can try and explain even through the app that the duration of the contract is going to adjust accordingly. It's a really good point. Thank you.
Follow up on that. Maybe you can put monthly repayment, because there's also research showing that people often target, like in auto lending, in auto loan markets, they target the monthly repayment rather than.
So that was the monthly repayment in the app. Sorry, you mean as opposed to? So that was the monthly.
Michael's comment was that like you're not showing them that the total cost of repaying goes up, but you're not showing them that the maturity you have to repay.
So the app was showing the monthly payment. I think his comment was that I should show them how it impacts the duration of the contract.
Expected. I think because the maturity is going down.
Yeah, the maturity is going down. Yeah.
I was wondering about that. The distance driven, because I'd imagine you're thinking from I make more revenues, therefore I'm paying more, but it also reduces the collateral value the more I drive. So how does that interact the borrower's way of and the lender's way of looking at that?
You're saying we should one of the like a drawback of capping the payment would be that if they drive a really high amount, that they're also potentially damaging the asset. and the collateral value for the lender. Is that what you're saying?
I just like thinking how depending on your results, I don't know what you find, but then if the more I drive, the lower value of the asset as well, even though it's more revenue. So
Yeah, I mean, so like the reason that we thought about the cap is because, from like qualitative work, they suggested that it feels like we're taxing them on their effort if we don't have a cap basically there. But I take your point that if they drive excessively in a short period of time, then that could actually be damaging the value of asset. And I guess we just have to empirically observe. But that's the case.
A little bit related to that, but I mean, my impression is that a lot of this driving is also done for personal errands. Like, so suppose you're in that mid-range where you are at the margin of like, you have to go to hospital. I mean, of course, you'll go to hospital if you get sick or like broke your knee, but like, I'm assuming for liquidity constraints, when they're binding, like that might hurt that decision. So how are you thinking about like those instances being captured?
So, I mean, we're not we're saying that this is primarily intended to help the women in terms of economic empowerment, and we're going to support them in terms of being able to sell things on this platform. We're not saying that you can't use this for personal journeys, for example.
And I'm saying like implicitly that might lower that decision making in the sense.
Because I don't want to go to the hospital now because these guys are charging me per kilometer fee to go to the hospital. It's a fair point. But yeah, it's fair. I would think.
So 2 questions. The first is, there's a lot of evidence that people have these reference points. So as soon as in the control group, do you see bunching at the monthly repayment amount? And does that change in the control group, in the treatment group, I mean? That would be interesting because then it suggests that maybe they're not just chilling out after they've hit the reference point that you've set, because here, the reference point is endogenous. And the second question is, what's the pricing model in this place? So doing lots of little short trips, are those going to be more remunerative than doing a couple of long trips? And does this particular slider change the way that they generate their labor input? And actually, frequent small trips are probably more likely to damage the collateral to build on what Jan has said.
No, these are 2 great points, and because it's just going into the field, these are things that we would have to observe. The trips thing is interesting. I mean, when we came into this, and we'll look for this bunching point that you made, which is an excellent point. The trips thing is interesting because when we came into this, we really thought they were going to be excited by this idea of using Uber, the Uber platform. And they were averse to it for a few reasons. They were charging a lot, this platform, but it seemed that many women wanted to basically do school trips, like school runs, rather than lots of small trips. They wanted to build up like a clientele of regular customers and take it offline, basically. And so that's something that we're hoping to observe. But it wasn't, our expectation was that it would initially be more kind of like ride-hailing type things, but it seems to be more kind of relationship type customers.
If I may, just one point. So we invested in a company that is providing EVs, 2-wheelers and 3-wheelers to rural women. And we saw some very interesting behaviors. One of them was that if you were underwriting, financing of these things, right, what they wanted you to tell them was what outcomes they were working towards. And so in this particular case, it was ownership, right? And with that in mind, they were then using more of these tools for commercial purposes, right? So they were using them to, help transport, food and whatever it is between markets and a bunch of things. And the other thing that was sort of interesting, I don't know if you guys are doing it, is that these women in sort of that covered distance in Kenya, they were buying these things in groups, in small groups, 2, 3. Then with the EVs, you were sort of reducing the OPEX by about 40 to 50%. So they would get into ownership faster. Then they would turn around and buy another one, and then they would choose who owns the one that's just been sort of acquired. And so I'm very curious, sort of how, as you're doing this, how you're communicating to these women, sort of what kind of behaviors you want to see them sort of want to influence to get them to be able to sort of adopt this, rather than just sort of more commercial behaviors versus just personal.
We should have a talk on it. It's a great transition for a man who's done a really nice paper on groups and getting assets together. So I'll leave it to Vittorio.
Thank you. So thank you very much, Emily, Emmanuel, and the organizers. It's great to be here. This is very preliminary, so every comment is very much welcome. So Agri-SMEs, so think, for example, of processors or coffee mills and so on, they play a crucial role in the agricultural sector in lower-income countries because they provide market access for farmers, therefore increasing productivity along value chains and potentially even just increasing farmer welfare and reducing poverty. This has been established, including in work by Lauren, for example. However, agri-SMEs may be difficult to finance. These are firms that require they have high working capital needs. They are subject to agricultural risk. They have a seasonal business. They sometimes have low collateral. They're often in remote areas outside the capital city and so on. And again, some of this has been established. So it comes as no surprise. I think the governments around the world are starting to intervene in these agricultural markets through, for example, interest rate caps and so on. So the question at the heart of this project is really how well do credit markets manage to allocate finance to agri-SMEs in Africa? We're going to try to answer this by looking at both the supply side and the demand side of the credit market. So we're going to start by showing evidence from a survey of agri-SMEs that we conducted in Uganda. And we're going to use it to show some key facts about financing sources in this context. Then we're going to exploit an initiative, a supply-side initiative called ASELI, that partners with lenders and gives financial incentives to lenders to increase or to target, to increase access to finance for agri-SMEs. They've been rolling out their activity across 5 countries. And so we're going to use this to start looking at the supply side of the credit market. And then the last part, which is very preliminary at this stage, of course, is to start thinking about pairing this with experiments with firms on the demand side to understand more on the demand side of the credit market. So let me start by sharing a couple of key facts from this survey. This is a representative survey of 3,000 agri-SMEs in Uganda. Let me define an agri-SME. These are firms that make at least $30,000 of revenues per year and employ at least 5 employees. So the first key fact from this is that only, out of 3,000 of these agri-SMEs, only 20% had a loan from a commercial bank in the last year. Now, this could be because perhaps, these firms are accessing finance from other sources, such as microfinance institution, informal lenders, friends, SACCO, savings groups, you name it. So we ask about all of those. And so when you look at the share of firms that has access to any external finance is about 50%, okay? So even of these relatively large firms, half of them only uses retained earnings and personal wealth to finance their operations. Now, looking more at the intensive margin, we have data on each of these loans from any source that they report in the survey. And here we can plot all the loans in our data, with the interest rate. These are scatter of interest rate versus loan amount, separating the source of the loan, whether it's coming from a commercial bank, those are the blue dots, or it's coming from any other source, and those are the red dots. And what you see is that, for small loans, less than $1,000 or so, really the market is dominated by these by these informal lenders or non-commercial bank institutions that charge very high interest rates. The weight is docked by sort of the value of all lending in that bin. So when you start looking at loans of like 3,000, 5,000, 10,000, 20,000, this large scale, you start to see that banks are really the ones that dominate this market, but they also charge relatively high interest rates, around 20%, that are much higher than the interest rate charged by these potential other lenders. Now, what's interesting, for each of these loans, then we ask the firm, would you have liked or would you like to borrow more money at these conditions? 70% of the firms say yes, even of the ones that are borrowing from these relatively expensive credit from banks. And so, when you put these things together, it starts to motivate a little bit the project by saying that there might be evidence of credit rationing at prevailing rates. So then what we do, we look at the supply side intervention. This is ASELI. This is an initiative that raises funds and then partners with commercial lenders across East Africa, and with the aim of increasing funding to agri-SMEs. And so once a bank joins ASELI, they start receiving, for each loan that they bring in that is eligible for the ASELI incentives, and I'll talk about eligibility, they start getting 2 types of incentive. First is an origination incentive. That is just a direct payment that gets to the bank that is meant to cover administrative costs, the origination costs of going visit the firm and setting up the loan. But they also get a first loss coverage, which is money. It's a share of the value of the loan that gets put into a reserve account and can be used to in case of default. So the eligibility are loans between $10,000 and $2 million coming from agri-SMEs like the ones that I've described. We're going to exploit the staggered rollout of ASELI across 45 lenders in 5 countries from 2020 to 2024. We have 2 kind of pretty exciting sources of data to start looking again at how banks respond. First, we got access to the credit registry of Uganda that includes the universe of loans from any institution. And then we also have admin records from the partner banks that eventually join ASELI before and after they join only on the agri loans that they give out. So I'm going to show some results from the credit registry. So this is data using all loans in Uganda. And so this is only using, of course, treated banks in Uganda. This is an event study at the bank quarter level. So here it's going to show the average interest rate charged by the bank in that quarter. So you see that after banks join ASELI, they start reducing the interest rate that they give out. This is a very robust result. So it's 1.5% reduction from a mean of around 20%, with no evidence of sort of decay of sort of fading away. Now we start to see on the sort of credit amount, there seems to be some positive effect. It's imprecise still. This is still preliminary on the quantity, total value of credit given out by the bank at that quarter level. Okay, so these are the results are very similar actually when we replicate them with across all 5 countries using the admin data from the banks that we see. Okay, so in the last 2 minutes, let me talk a bit. Okay, where are we going from here? This is now the part that becomes very kind of thinking about the future in a sense. So we have documented that there is kind of low participation of firms in the credit market and low credit provision. Now again, this could be quote unquote efficient, right? It could be that a lot of the firms that don't borrow have low MPKs, or it could be that there's a high marginal cost of funds for the bank. But there could also be sort of inefficiencies potentially explaining some of these outcomes. It could be that borrowers cannot set the MPK equal to the interest rate because of frictions, for example, related to selection market, type frictions and asymmetric information. Think about adverse selection, for example. There could also be borrower search frictions. The firms don't know how to shop around or don't know the rates charged by different banks and so on. And of course, in addition to these kind of frictions, there could be that the interest rate is just high, 21, 22% on these large bank loans because of bank market power. So how are we going to try and make some progress on this? We're going to build and estimate a structural model to try and recover demand and costs. So let me walk you through a little bit some of the ideas here. Now, ASELI is nice because this is a supply side shifter. And so ideally, it's going to, we can start to learn about demand by seeing, how, the quantity of loans increases and the interest rate. But also we're going to think, and this is kind of really looking ahead, about designing some demand side experiments where you perhaps, you can offer discounts on loans to firms. So imagine pairing firms with banks, offering loans, but then giving a discount to start to see how to start to recover the marginal cost that the bank faces in giving out these loans. But then again, we're going to try and understand whether that's coming from, just costs perhaps related to origination or administering these loans, or it's coming from informational asymmetries. And there, what's nice, going back to the diff in diff, and this we haven't done it yet, but this is where we're going. We can start looking at what happens to who are these new borrowers that are borrowing from ASELI? What is the default rate? What is the delays that they experience? What kind of, are they repeat borrowers, new borrowers? Because we can follow them through the credit registry data to start understanding whether these are really selection markets and whether the marginal cost is coming a lot from, this increasing marginal cost potentially is coming from selection markets. Okay, so eventually we hope to do some counterfactual analysis to help the design of policies to increase credit provisions in these kinds of markets. Thank you.
I have kind of question observation, I guess. From my job market paper, when I worked with Brazilian farmers, most of them were borrowing from the agribusiness, the sourcers of the output of what they produce. For various reasons. One was because it conveniently matches the life cycle of the product. Then it was information asymmetries, product market failure.
The farmers borrow from the processors.
Yeah, that was the main borrowing.
Yeah,
we're never borrowing from banks, and it wasn't because of the lower or higher price, but it was just much more convenient. So in your sense, you don't have trade credit part, right? You only know the bank credit.
You know the bank trade credit.
Well, but you want to know the trade credit.
Yeah.
Because that was the really important one. So that's
a good point. So very good. So I think we ask in the survey, we don't see it in the admin data in the credit registry, but in the survey, I think we asked to the banks, to the processors, the Agri-SMEs, do you extend trade credit to the farmer? So this is something we could look at. I mean, in fact, the theory of change of ASELI is, the processor is going to borrow more. They're going to pass down some of this by, additional trade credit or better conditions, more, kind of servicing more farmers and so on. So there's a whole sort of downstream here action potential. So we can start to look at with the survey data.
No, but SMEs, those are the ones who are borrowing, right? They also could be borrowing from somewhere else. So you need to know what is their...
The farmers.
No, the SME.
Yes, yeah.
Oh, that's a farmer in your...
No. So the SMEs are the ones that are borrowing from us. They're eligible for these bank loans. The SMEs can be borrowing from other sources. So those are captured in the credit registry, some of them. But yes, and then there are the farmers who are potentially, there's trade credit between the processor and the farmer, and then there are the farmers that are borrowing from other sources. We can see in our survey data where the firms, the Agri-SMEs, are extending trade credit to the farmers. Indeed, Asseli hopes that this is a mechanism that is going to.
But I guess the spirit of this question sounds to me like are they delaying payments to the farmers, which is essentially trade credit coming from the farmers to the
And
processor.
also the processor itself will borrow from somebody else in trade credit.
But the trade credit is from a supplier, right? Who are the suppliers? The suppliers are the farmers.
And that's the important.
So the suppliers are the farmers. So the question is, are they currently delaying payments to the farmers? And you're saying when they get the credit, they may actually provide credit to the farmers.
Or
But they-
pay more on time.
Or pay on time, but they could now be, that liquidity could be coming from the farmers as delayed payments.
Yeah.
I don't.
Yeah.
Context, but.
In the red dots here, there is also trade credit. And it could be that some of these are like even informal loans or trade arrangements with the farmer. Now we can try to distinguish where this trade credit comes from. It's not a large share, but there is definitely some here. Now this is not going to show up in the credit registry data for Uganda, but as long as, in survey data, right now this is kind of in the red dots. But yes, I agree, this is important, part of this. There was, Oh, I think, the mod, Nicola then.
Do you observe whether the loan is collateralized, and do you see the default rates?
So we see, yes, yes, we do.
Because, this is important in trying to teasing out the marginal cost of the bank, the monopoly power, and in a sense, the information rents basically coming from moral hazard. The exercise on new versus repeat borrowers is going to be useful because I'm more inclined to think that a decline in marginal cost from the bank is going to be passed on repeat borrowers rather than new borrowers. Also because, interest rates are a way to screen borrowers. So at the same time, if also new loans, interest rates go down, it's nice because you can try to see from the credit registry whether it's reallocation across, which is people moving from worse borrowers to better borrowers, or if it's people that were not using any credit, bank credit, that are joining the system.
Yes, exactly. So we can do most of that with the credit registry data. I think that's why it's so helpful to have it. But yes, I agree. It's great. Thank you. Very good.
Yeah. So I was a little confused. So the way I understand the stack is that you've got farmers who are literally the ones doing the work.
Yeah.
In the markets that we operate in, then you now have this construct of an aggregator.
Yeah,
and the aggregator is the one that essentially harnesses all the farmers.
Like a cooperative?
No.
Like a processor?
No.
Oh, there's an aggregator. Okay, so there are different. Yeah, okay.
So there's an aggregator, and so the aggregator is the one that essentially now does all the deals with the large off-takers, right? And so the aggregator is now financing the farmers.
Yeah.
Right. And then so I'm very curious, and they're getting money from non-bank sources.
Yeah.
I'm very curious sort of about that particular tier because it seems like it becomes more and more important, certainly in Nigeria, for instance, because the farmers trust those aggregators because they get paid faster.
Yeah. So this will be somebody that collects all the produce, then brings it, but he will bring it to a meal.
Or something.
So I think most of these loans from Asseli are loans for the meal, not for the aggregate. So these kind of eligible loans, or these are intended for like a coffee meal or a processor. But
in Nigeria, these processors are not doing deals with the farmers. They would do deals with the aggregators.
Correct. So sorry. Yes. So with this kind of chain, yes. So what's interesting here, there could be heterogeneity by value chain, for example, where the structure of this value chain is different. But eventually, yes, we do want to look at outcomes downstream as well, ideally. Meaning, the SME then kind of passing through some of these gains ideally. So here we're still at the stage of the bank, but then ideally want to look at counties.
We connect to Nigeria for an RCT next.
Yeah.
Okay, wonderful. Thanks so much to the organizers. Today, I'm going to stick in this world of agriculture. I'm going to go even more micro and talk about farmers and hopefully convince you that the insights that we gain from farmers will also sort of apply to firms as well. And so where this project starts is with this understanding that beliefs can be an important input to farm production. And the reason we should care is just because agricultural production is such a big driver of economic growth. So we have 500 million smallholder farmers worldwide. They produce 30% of the food. They contribute 20% of the GDP and 40% of the workforce. And what's interesting about agricultural production is that it depends on the weather, right? And that makes things quite complicated because what it means is that farmers are going to have to make decisions before they know what outcome the weather is going to show them. And so they're going to have to rely on their beliefs. And what that then means is that these long-range weather forecasts that are starting to emerge, so these are forecasts that provide information to farmers well ahead of the planting season, they have the ability or the potential to realign farmers' beliefs with actual realizations. And in doing so, that should improve welfare. And I want to take a second to just mention that we see these weather forecasts as being different from sort of standard information interventions insofar as what weather forecasts allow you to do is they allow you to reoptimize investment on multiple fronts, not just in your agricultural business, but also maybe across businesses into non-ag business as well. So we are going to ask 3 research questions centered around this importance of beliefs and forecasts. First, how do beliefs impact investment? Second, can a high quality, low cost forecast bring beliefs closer to realizations as a first step? Does that then change investment behavior as a second step? And does that then in turn improve welfare? And I won't get to the third part today, but then we look at how beliefs matter for other policy interventions beyond information. So in this case, insurance, and that's in the paper. And so you might be asking yourself, well, why isn't this obvious? Why shouldn't forecasts just make things unambiguously better? And I think there's a couple of reasons for this. The first is that farms may not be able to act on their beliefs. Maybe I think it's going to be a great growing season, but I'm constrained in terms of the amount of land, labor, or credit I have access to. Secondly, farms may not be able to respond to forecasts. Maybe they don't trust them. Maybe the forecasts don't come with enough time to actually make big changes. And so forecasts are now really being touted as transformational, but they largely remain untested. And so what we're going to do is, what we did, is a randomized control trial in India where we randomized villages into, the focus for today, into a control group and a treatment group. And the treatment group got these long-range weather forecasts, which were basically an accurate forecast for when the monsoon was going to arrive. And we show in the paper that monsoon onset timing is really important for agricultural decisions and outcomes. And then probably too much for an 8-minute presentation, but I'm curious on your take about this, but broadly, we think we contribute to this literature that's showing that beliefs matter for farms. And in doing so, we think we're contributing, or we hope we're contributing to sort of a small literature on firm beliefs as well. So there's a couple of papers in the macro space that look at the importance of providing information on interest rates, for example. There's a little bit work on belief formation in LMICs, but we're sort of taking beliefs as given and seeing how they ultimately affect investment and subsequent outcomes. And then we sort of speak to this literature on the role of weather forecasts as a way to sort of mitigate uncertainty that farms face. There's been a little bit of work on this, or there's been a lot of work on reducing weather risk, less so on forecasts, and where we're sort of positioning ourselves as really trying to understand the interaction between forecasts and beliefs. A note on generalizability that I'm curious to get your take on. But we think that, we hopefully convince you that beliefs and forecasts matter for farms, but we also think that this has implications, for firms, in the sense that firms are also making decisions under uncertainty. They have to make decisions whose outcomes depends on the state. But they have to decide before that state is realized, therefore relying on their own beliefs. And if firms' beliefs don't match realizations, that can have important consequences. And so, you could think of the example, Vittorio with Agri-SMEs, they also presumably would care to know when or how the weather is going to be affected. Or you could think of construction firms that build houses before demand shocks are realized. So pivoting now into the results. So the first thing we want to show you is that farmer beliefs about the monsoon, something that happens every year, are actually quite dispersed. So what I'm showing you here on the x-axis are weeks of the year. We asked farmers, when do you think the monsoon will arrive? This was the actual onset date right here, and you can see just very large dispersion. The second thing we show is that farmer beliefs matter for their investment behavior. Now, this is a graph that's in the control group only, so it's cross-sectional, it's correlational, but I think powerful in showing us that there does seem to be farmers for whom, farmers' investment behavior does respond to what they think will happen. So here what you have is weeks on, again, the x-axis. What we're calling early priors are farmers that think the monsoon is going to arrive early. Therefore, they're going to face a longer growing cycle, and a longer growing cycle we show is better for agricultural outcomes. And so you see their investments are higher. Conversely, what we call late prior farmers who think that the growing season is going to be shorter and therefore less good for agricultural investment, they reduce their investment. So step one, we show beliefs are dispersed. Step two, we show that beliefs seem to matter for investment. Step three is we show that forecasts can indeed move farmer beliefs closer to the forecast. So again, week on the x-axis. Here is where we said the monsoon would arrive. This was an accurate forecast, so the monsoon did arrive in this window here. And what we're showing you is that the posterior beliefs of farmers in the treatment group that got the forecast in purple are indeed closer to the predicted date relative to the control group in gray. Okay, so in my last minute, we've got some theory that basically says that beliefs should drive your response to the forecast, right? And so how to think about this is as follows. If you are a farmer with early priors, so you think that it's going to be a long growing cycle, you get a forecast. In our case, it was sort of an average year. It comes basically saying, hey, actually it's later than you thought it was going to be, aka it's a less good growing season than you thought it would be. You should respond by decreasing your investment. Conversely, if you're a late prior farmer, someone who thought that the growing season was going to be quite short, and I surprise you and say, oh, it's actually longer than you anticipated, it's going to be a better growing season than you anticipated, then you should increase your investment. And so this is sort of the pattern that we should see in our data. And so the last 40 seconds are going to be showing you those results. So here we collect a number of measures for investment. The first is cultivated land, so how much land you choose to invest. You have the amount of cash crops you choose to plant, where longer growing seasons are better for cash crops, total expenditure, and then an investment index. And you see that pattern that you would expect, right? With farmers who sort of get surprised this is going to be a worse season than they anticipated, decreasing investment, and farmers who think, oh, it's a longer, better growing season than I expected, are going to increase their investment. And conversely, I motivated this as forecast being able to allow you to adjust on multiple margins. And so what we see is sort of patterns, again, consistent with them moving into non-ag investment. So the people for whom, agriculture investment was contracted, they then sort of expand their non-ag businesses. And then lastly, what we find is we look at what this ultimately means for like our ultimate, welfare measures that we care about. And so we look at this across food consumption, asset value, savings, and a welfare index. And because I'm out of time, we'll just focus on the welfare index. The welfare index increases by about 0.08 standard deviation, which as far as I can tell is relatively large in the literature. There's a big irrigation scheme in Rwanda that finds a 0.1 standard deviation increase, but these forecasts are super cheap to disseminate. So they're just very cost effective. Okay, I'm done. Thank you.
You said they're accurate forecasts, but how accurate are these? I mean, what is the who's?
Yeah, so this was
PhD, or this is who is doing the forecast?
Yeah, so this was a climate scientist at the Potsdam Institute for Climate Science, and they had been doing it. It was accurate every year for the past 10 years, including our year as well.
And that's conveyed to the farmers that this is accurate.
Yes, yeah. We had a whole information poster and things. Yeah.
Thinking about the kind of household portfolio businesses, when you see them having a negative shock in terms of the ag, they're moving into non-ag.
Yeah.
Do you see them later coming back in, or are they kind of?
So I think a lot of these farmers are always sort of dabble a little bit in both. So we don't have the second year of data to. Actually, we maybe could. We do have some data that maybe we could look and see if they sustain that. But these are sort of fluid. They sort of have a portfolio, and so they tend to be able to go into either pretty quickly. Yep.
So there's some work, including some stuff I've done in the past, that suggests that financial constraints determine both the way you respond to your own preferences and your own beliefs. So what would be interesting is you had a distribution of how much people shifted their beliefs. It didn't seem like very much. I wonder whether the people who don't shift very much are the ones who have the most to lose if they do shift.
Okay, I guess the people who don't have the most to lose. And
imagine that you're super risk averse because your financial constraints have pushed you really close to the default boundary.
Mm-hmm.
At this point, someone expert comes along and gives you some information. You've got to update your prior.
Yeah.
But then if you get it wrong because of the update, you're really screwed.
Yeah.
So it would be interesting to check whether that's actually going on in your data.
Oh, yeah, I think that's something we could explore. Thank you.
wondering if they anticipate any general equilibrium effects. If they anticipate like it's a better growing season than expected, and there would be overproduction, and the returns on investment might be lower.
Yeah, so interestingly, so this evidence sort of helped us work with the Indian government to expand. So there was sort of 1 million SMSs that were sent out to Telangana last year, so that we can look at whether there are G effects. Preliminary data suggests no, which maybe farmers thought that they would, but we were only providing this to 5 farmers in the village. So and given just how much people interact with these farmers and give either ag extension or things like that, I don't know that they would be thinking that this is going to have dramatic impacts on the markets.
Question. I was curious, what are the inputs that sort of drive the early prior cohorts? Like, what is it that they know or believe or have seen that allows them to make those decisions early versus, because you're giving the same information to everybody?
So we're giving the same information to everybody. If I'm a farmer that thought, oh, it's going to be a very long growing cycle, that's great, and you actually tell me, oh no, it's not going to be, then what I can do is I can contract the amount of land that I plant. I can choose different crops to plant, and then what we see is that they also shift a little bit into non-ag businesses. So I think they can make a number of decisions because they get this information 5 weeks early. But like if we had analyzed this data just in all one clump and didn't sort of break it out by beliefs, it would look like zero, average treatment effects across the board. So it was really important, even though they were getting the same information, because their priors were so different, that affected how they interpreted the information they received.
Do you have any insight in terms of willingness to pay? Because I'm assuming the fact that they do not have access to this because they.
Willingness to pay is low, but it's in line with an insurance product that we offer that paid out about $100 in the case of rains arriving late. So it's like in levels low, but a relatively high, I would say.
Did you look at migration?
We don't have any outcomes. I mean, we did measure it. We don't see anything on migration.
Don't judge me. I realized afterwards I had as many papers as Polak.
Hey guys, thanks for sticking around for the last talk. This is joint with Emanuele and Tim. And I think this is actually like a pretty good paper to end on. It's a pretty big picture paper. The question that we're going to be trying to answer here is, why doesn't capital flow more aggressively from richer countries to poorer countries, which some people call
Not why does Emanuele write so many papers?
That's it. That's question 2.
There's no paper actually.
So many slides.
So and what we're going to do in this paper is put information front and center, and we're going to ask sort of a little bit more of a targeted question: do investors have enough information about emerging markets? What I'm showing you is basically some measure for information plotted against some measure for how important a country is within the global economy. So it's the share of information and its importance to the global economy as proxied by GDP. You can see there's a pretty strong relationship between the amount of information that's produced and its share, its importance in the overall economy. Now, our measure of information, which is going to be the main data innovation that we bring to bear in this paper, is the number of reports that global banks write about various countries or various companies that are in those countries. So what we've done is we've collected all of the metadata for every single equity analyst report that's been written by a global bank since 1990, about 17 million reports. And what I'm plotting on the x-axis here is the share of those reports written about each one of these countries. And so the first thing that kind of comes out here pretty immediately is that emerging markets are pretty underrepresented in these reports, as you can see in red here. But we don't necessarily think that that's the full story. I mean, a lot of the reason why these banks end up writing these reports is because there's demand from foreign investors that actually want to invest in these countries. And so maybe this isn't necessarily like an EM-DM sort of thing. It's more like a high foreign demand, low foreign demand sort of thing. We can actually see this when we shade in some of these countries based on whether they have above median foreign capital positions over GDP, which we're doing in green here. As you can see, a lot of the emerging markets and developed markets that lie below that line, that are overrepresented in terms of information, are high foreign share places. Now, of course, it could be that these reports don't matter. And so the first thing that I'd like to do is I'd like to convince you that there is indeed an important two-way feedback loop going on here. That one, foreign capital investment creates information, and that two, information creates foreign capital investment. The next thing I'd like to do is I'd like to interpret this within the context of a model that I won't have any time to describe to you guys, but I'll kind of broadly sketch out, and I'll talk about, one, how this might allow us to quantify the importance of information in the Lucas paradox, and two, think about some policy counterfactuals that maybe emerging markets could pursue in order to get around that. All right, so again, I said the main sort of data that we're going to bring to bear to answer this question is this metadata on these equity analyst reports. It's a really cool data source. It's all reports that have been written since basically 1990 by global banks. We have the bank that wrote them. We have the actual person that wrote them. We have the company it was about. We have the country it was written about. So we have a lot of information, and then we have a small sample of these reports, which we actually have the underlying text data. We're not going to do anything with that today, but we are looking to do stuff with that going forward. But the main sort of identification concern that we want to deal with here is that there might just be some good idiosyncratic news about a particular country, and then both capital flows into that country and there's a bunch of reports that are written about that. So we're going to have two different strategies that we're going to use today to try to deal with this. Strategy number one is that we're going to isolate global variation in cross-country data in both capital flows and report production, and then use that as an instrument here. So the way that we're going to do this is we're going to assume that both capital flows and report production follow a factor structure. We're going to estimate the factor structure or the factors using principal component analysis. We're then going to estimate exposures to those factors using just OLS. And then we're only going to use the variation that's driven by that systematic portion, not the idiosyncratic variation in these other things. The next thing that we're going to do is we're going to use sort of a more standard Bardic style approach, where we're going to use the fact that we have basically bilateral data on these reports, because we know where the bank is located that's writing the report. We know where the report was written about. And we also have bilateral data on certain kinds of capital flows. It's actually very hard to find national accounts quality data for bilateral capital flows. It's something I learned in writing this project. So to do this, we're going to use venture and private equity flows from PitchBook. So we're going to use two different identification strategies here in order to show that information matters for capital flows. Okay, so I'm going to start off by showing you that capital flows beget information. So this is the first end of our two-way feedback loop. So the first stage here is that, using that systematic variation to drive up the foreign capital position, all panel A is saying is that capital flows follow a factor structure. So it's nothing necessarily special. We get some pretty good variation from that. The more interesting thing is that shocks to capital flows do indeed seem to lead to more reporting about the particular country that experienced the shock. And you can see that there's an effect that goes on and continues to increase up until about 2.5 years out. These are all at a quarterly frequency. We also find that the increase in capital flows tends to drive down measures of uncertainty. Particular idiosyncratic vol is measured through the idiosyncratic portion of stock market volatility goes down, as does more sort of text-based measures of uncertainty like economic policy uncertainty. So that's leg one of our two-way feedback loop. Leg two, we're now going to use a shifter on report production, and we're going to do this in two different settings, like I said. One is using that sort of factor structure approach. The second is using a standard sort of Bardic shifter. I also didn't say what we're actually showing you here. These are all local projections around these different outcomes. So these are all, I didn't say what we're actually doing. It's all local projections. So we have a very strong first stage on both of these. And then once we instrument the report production and we do the sort of pass through the capital flows in that cross-country setting, we see that more information begets greater capital flows. So there is indeed that second leg of the two-way feedback loop, and we see this also is especially true in venture capital and private equity. So it's both that capital flows create information, and information seems to create capital flows. The last thing that we do is we try to interpret this within the context of a model. The sort of very fast setup version of this model is that there's going to be a small emerging economy with two different kinds of entrepreneurs that are born in an OLG sort of fashion. The first are going to be foreign entrepreneurs who have a really high risk-bearing capacity, but have very sort of low information. The second are going to be domestic entrepreneurs that are highly informed, but have relatively low risk-bearing capacity. The foreign entrepreneurs are going to receive noisy signals about the potential business value that they get, and the precision of that signal is going to depend on the level of FDI of the previous generation. Now, what this is going to create is sort of an information externality, right? So the entrepreneurs are not going to internalize how their investment impacts the future investment of other entrepreneurs. So there's going to be an under-provision of foreign capital. And so this is also going to, so there's going to be an under-provision of foreign capital. It's also going to allow for some sort of, I know I just ran out of time, amplification, so where a reduction in FDI can lead to prolonged increases in uncertainty. This is going to give us sort of long-lived sudden stop episodes. And it's also going to allow us to talk a little bit about how much missing information matters for the overall Lucas paradox. And two, it's going to allow us to explore policy counterfactuals. I'm done. That's like only 30 seconds over. That's pretty good.
Max, I have a question. One thing that is missing here are credit default ratings. That's a standard measure of information on financial markets, right? So is that something, I mean, how should I consider the ratings that, you know, Fitch, Moody's, and Standard & Poor's give? They are not reports from global banks.
No, that's true. I mean, I guess we could use something like government sovereign, like, you know, the ratings on sovereign debt would be.
I don't know if what you're presenting is about sovereigns or corporate.
Yeah, I think most of what we're talking about here is going to be, you know, corporate investment. We're thinking about, you know, FDI. We're thinking about VCPE investment, where these ratings are not necessarily going to apply.
Then you would want to see that, so that this information is something
distinct from the country specific.
Otherwise, you can just use that.
That's something we can.
So you know, that would be a first pass. I mean, that would be what I think about production of
The
information.
reports, to give you an idea, it's like an investor writing 20 pages on a company in Indonesia, saying how like competition is good, it's bad, and so on. So, for example, or it would be a macro report by the IMF or Goldman Sachs on, let's say, the financial sector of Nigeria. So they are very micro compared to what the things are involved in. But we can do a lot more for sure.
If I miss it, but are these effects concentrated among developed markets or emerging markets?
Right. So on the second one, I showed you that this I didn't get to go over. That we showed basically all emerging market, the emerging market population. So the effects actually end up happening in both, but they are equally true for emerging markets and development.
So I guess I would have expected the reports, so if we think about low-income markets as being somewhat more opaque and variance being higher, I would have thought the reports are less informative, are more informative as I go across the GDP axis. There's heterogeneity that lines up with per capita GDP. And I guess, is there any evidence of that? I mean, you just said that it's the same for emerging markets and developed markets, so maybe that's not the case,
Yeah,
but how do we think about
So
that?
it's a little bit difficult to do this because a lot of the shifts that we're doing everything in logs here. And so like we're talking about what happens if you double the amount of reports that are written and what the effect is there. A single report is a lot more important for an emerging market country, but it turns out that if you double the reports for developed markets, you get sort of a very similar effect. So any sort of single bit of information tends to be more important for emerging markets, but the effect in logs ends up being
And you have a lot of action and a lot of reports at the middle of the Brazil, Indonesia, the Vietnam type, more so than the US or Tanzania, Sierra Leone.
Right.
Yeah, I don't think our variation is not coming from the US either. So
Right.
I wonder how you handle the issue of a quantity versus quality of information, right? At the end of the day, this report plays a role as like a filtering information and give a signal of quality. But if you think in terms of a quantity, I would expect that with technology, access to information direct to the source became more available, and the marginal effect was probably more relevant in emerging markets than.
Yeah, I mean, so another way to put this is that their reports could also be more informative on the intensive margin as well over time. This is something we're like playing with doing because we do have some of these reports. It's difficult to get sort of an off-the-shelf measure of how informative a piece of text is relative to another piece of text, especially when the texts are pretty similar. So we're working on this, and it's sort of the step 2, but we haven't quite got there.